Hi Mortgage Heroes, Andy Cruz here in Business Development, and this is Monday Mortgage Minute. We just can't seem to catch a break, can we? I mean, 1 minute we think we're going in the right direction and then wham, something new comes out of left field. Well, that was last week when the CORE PCE number, the Fed's main target barometer for inflation, came in higher than expected, which is in the wrong direction. The CORE PCE number came in at 4.9%, which is higher than we were looking for, and it went up from the previous month's reading. This is unfortunate for a number of reasons because for months and months this year, the Fed has been tightening Fed policy, increasing the Fed funds rate, and it does not look like the CORE PCE number has budged at all. So their target of getting us back to 2% inflation just got a little bit tougher. But wait, there's more. The overseas markets last week were getting pummeled. You had currency issues, you had bond market issues, both in Europe and in Asia, with the England and the Japanese markets having a lot of duress, and their central banks having to step in and take emergency action to prevent further calamity. Now, on the surface, that may not seem like that's a big deal here, but it is because it's in relation to the US dollar and the strength of our dollar here on this side. As the dollar continues to increase in its strength, it makes other currencies it's paired with become weaker, and that caused some ripple effects through the markets last week. How does this have to do anything with mortgages? Well, the Fed's stated goal is that they're going to stay in restrictive territory until they feel like they've gotten to their inflation target of 2%. And what that means, though, is that all things connected to their sentiment have an effect to that. That includes the bond yields, that includes mortgage-backed securities, that includes the strength of the dollar. All of these things are baked in the cake together. And as we saw last week, mortgage rates were on wild, volatile swings. When the CORE PCE number came out higher than expected, rates shot up really fast in one day. And then 2 days later, they plummeted and they came down, almost reversing the entire move. Even coming into this week, mortgage rates are better today on Monday than they were at Thursday and Friday of last week. Now, even though that may be true, we're still not changing our course of where we think the direction is because the overall trend is still in the upside. But like we've been talking about, there will be days where in the mortgage industry, rates dip down, they hit a little bit of a bottom support zone there, and they'll stay there for a little bit. Sometimes it's only a day, maybe 2 days, but they're not changing course and direction completely yet. And that's the thing I wanted to let you know about. You're going to see wild and rampant moves in the market right now, especially as there's so much volatility, especially as there's so much uncertainty. I mean, even as I'm recording this right now, the Fed is having an emergency meeting. Now, I don't know exactly what's going to come at the end of this meeting. Not sure exactly what it is they're deciding on and what they're discussing, but I do believe that the turmoil in the markets from last week has caused them to have an emergency gathering to decide what they're going to do policy-wise in advance of their next meeting, if anything at all. So on one hand, that can create a lot of uncertainty, and on the other, it's kind of just par for the course. I mean, Q3 was wild. It ended pretty weak and poorly, and I think that people are looking for a little bit of a sense of relief in the markets in Q4 and hopefully have a little bit of a relief rally, and maybe that'll ease up some of what we're seeing as far as mortgage and real estate is concerned, but our base case for the fundamentals changing is still not there yet. We still have home prices really high. You're gonna see some corrections still. You see mortgage rates putting a pinch on people's affordability, even though there's days when they dip down and they come back in favor of you financially on your monthly payment. So I think it's really important that right now, if you're in the market or you're on the sidelines hoping to get in the market, you take a very close look at the neighborhoods and the towns you're looking to move to. I do believe that in this fourth quarter, there's going to be some opportunities for those of you who are ready, for those of you who are prepared, for those of you who have already done the work and you've done your research. I think there's going to be great opportunities for you in this market in Q4 before we get into 2023. And that leads me to my next point, which in case you missed it, there is an increase in the housing allowance and the base pay for all of our active duty service military members. For those of you here in San Diego, you're gonna have a bump in not only your base housing, but also in your base pay to help close the gap between what it started at the beginning of the year and where we're facing ourselves right now with the cost of housing in San Diego and the inflation we're seeing here locally. And it's not just for San Diego. If you're outside San Diego and other parts of California and you're stationed at other bases, those are in effect in those bases too, but the rates are different. So it's really important that when you're talking to your loan officer about where you're either PCSing to or from, that you have an identification and an understanding of what exactly it is you're walking into and how that can support your housing endeavors when you go. Lastly, there are a couple things happening this week that will have an impact on the mortgage market in broad terms moving forward. First, you're going to have the JOLTS report coming out on Tuesday. That's the Job Openings and Labor Turnover Survey. Next, you're going to have the ADP non-farm payroll coming out on Wednesday. And then on Friday, you have the newest unemployment number coming out. Now, all these together are going to help give us a broad macro look at our labor force and whether or not it is strengthening or weakening. And depending on whether or not it's strengthening or weakening, will give us some insight and some sentiment to what we should expect in the months and quarters ahead. Those of you in the market right now and you're looking to lock your loan, be prepared for wild swings in the market. There's up and down days where sometimes the rates are going 0.5 to 0.75% up or 0.5% down just on any given day based on what's happening in the money markets. And if you happen to miss the video, that memo I made last week about adding an ADU to your property, there has been a change to the ADU grant. It was $25,000 and it was increased to $40,000. There are a couple of similarities, but there's also some caveats to be aware of. And we both think that it's an indication that there's going to be more of this to come in 2023 and probably 2024 because the appetite for this has not only grown, but even though it's going to be met at its fullest capacity, it still will not solve our housing shortage. So we think there's more coming. Take a look at this video right here and see everything we talked about last week. As always, thank you so much for watching. Please be sure to share this video with people you know, love, and trust. Make sure you subscribe to the channel and you follow us on social media. We are going to be posting these videos on YouTube first. So if you're seeing this on social media, jump over there to YouTube, make sure you're on YouTube first, and turn on your notifications so you'll see this video right when it releases. And of course, any of you that have specific scenarios that you'd like to discuss with us together, please send a comment, send us a DM, reach out to us by email, by phone, text us, let us know how we can help you win in mortgage and real estate in 2022. Thanks for watching, and we'll see you again next week.